But if you look at today's market, these tech companies, these giants, they generate tens of billions of cash flow right now in this market and expected to generate that over the next few quarters, even in this environment. So technology today is a lot different than technology then. You can't look at back then and say, well, they traded 40, 50 times earnings, and they're only trading at whatever, 25 times earnings today. But they were trading that high. But it's these guys are generating, they're growing incredibly fast. And not all of them are trading at 40, 35 times earnings. I mean, you're looking at some good technology companies trading below 19. The average company right now in the S&P 500 is trading around 19 times forward earnings. But even when I go back to the NASDAQ and seeing that during the tech bubble in 2000, like you kind of understood it, right? You saw how bad things were, and eventually that was going to happen. Now, today, it's different because we've seen this sell-off since November. And outside of November, there hasn't been any news that is surprising. So we're seeing the risk. We understand the risk. And yet we're seeing, it feels like 1% to 2% downturns in the markets every single day. And this is based on what the Fed said, finally coming to terms where, hey, we have to stop buying treasuries. We have to raise rates. Inflation is insane now, over 7%. Again, almost anybody knew that outside of the Fed, right? We're all seeing it. We pay our bills. But you're looking at this risk is already on the table. We already know this. So most of it should be priced in, right? And when the Fed made that surprising statement that inflation's not transitory, we're going to aggressively raise rates. I mean, look, we were adamant about that going in and saying, wow, the Fed is going to have to raise rates. It should have raised rates a year ago. It's not transitory. And we're talking about once this happened and once the Fed reversed that, this is a fundamental change. I use that term a lot in these podcasts. It's a fundamental change in the marketplace. Things are different now. The Fed can't go in and just bail you out. They're taking money out of the system, almost have to force a recession, raise rates, stop buying bonds, all this, right? It's the only way to control inflation, taking money out of the system. Stop handing out free checks on the fiscal side. And a lot of this is going away. Also saying you should be buying puts to protect your portfolio. With that said, I had no idea it would be this bad and this quick. No idea. I was wrong on that. I knew meme stocks, and I was talking about AMC saying it should be trading around $5 and wherever it went to, 30, 40, 50, 60, 70. I mean, if eventually numbers matter. That eventually could stretch out, which stretched out for many, many years because we had easy monetary policy, free money. Everything was getting funded. Just early stages ideas, even in crypto that didn't even exist yet, were able to raise $10 million like nothing. That's what happens when you have low interest rates, easy money policies. So the meme stocks, space stocks, ESG names, stocks and sectors, with no earnings, sometimes not even generating sales, trading multi-billion-dollar valuations. I mean, I expected a sell-off on those names. I also expected a pullback in the overall markets, maybe around 5 to 7%, maybe 10% max off its highs. Looking at, hey, you know what? We're probably going to see a recession for two reasons. Fed's taking money out of the system. Also, if we look back at history, prior to the pandemic, 5% plus inflation presaged all 7 recessions over the past 60 years. And then when we had inflation of 7%, that resulted in a double dip recession. So where inflation is, you have to expect, okay, recession's coming, which is not the end of the world. It's not the end of the world. Recessions used to be normal. It's a normal course of action. It's just like a business that's aggressive, maybe too aggressive. It has to slow down and cut costs. It's normal. There's times that are great and other times that aren't so great, right? It can't be great all the time. The Fed was there making everything great all the time, making it very easy. Oh, we have problems. Keep interest rates low. Everything's at record highs. 1 year ago today, earnings hit record highs. 1 year ago. Home prices, record highs. Net household wealth, record highs. All this shit's at record highs. Every asset class at record highs. And what the Fed do? We got to buy more bonds. They injected, so far, close to $19 trillion into this market, just in the U.S. alone. And $10.5 trillion came during COVID, before January 2021. Another $9 trillion when asset prices were record highs and everything was going through the roof and everything. Another $9 trillion was injected into this market, which is insane. They should have been raising rates a year ago. Now they're behind the curve. They're well behind the curve. But you look at the S&P, the NASDAQ, great companies that reported blockbuster earnings last quarter and raised guidance, they're down 20% from their highs. Most Dow components, 52-week lows. Russell is down over 20% from its November highs. We're talking 2 months ago. What does that mean? It means many stocks within that, if you're looking at the mean, are down 30% plus from their highs. Again, just over the past 2 months. Okay, when you have COVID, when you have the credit crisis, you get it. When you have a Fed that just said we're changing policy, and they said that 2 months ago, and to see that's the same risk everyone's worried about right now as this leverage is coming out of the market and everything is selling, it's crazy. Because it's not just these high-risk companies that are getting crushed. Yes, they're getting crushed more than the rest of the market, but this is a broad-based sell-off in everything. Again, we saw that at Monday at the bottom when 90% of stocks are lower. Holy shit, that's unheard of. Like, that's a catastrophe. That's like we're going to war, Russia type thing. Like, everything, sell off everything. I mean, it's insane when you think about it. But it's something I've never seen in terms of, just a massive pullback in the market on really no new news. Right? The Fed news of tightening was in November. Inflation is at 7%. No surprise. Been there for a couple months now. We knew it was going higher. Some increases to the Fed rate hikes, right? They said 3, and now some firms coming out 4, and I'd be surprised maybe it's 5. But I think the consensus is for 4. It was 3 like 2 months ago, so I understand a little bit there. We really got to control inflation. Yes, interest rates on the 10-year are higher, but still, we're at these levels less than 9 months ago. And before 9 months ago, we were above 1.7% pretty much since 2013. Pretty much since then. I mean, we're not like 2.25 on a 10-year. We're not, 2.5, rising at 3%. Holy shit. We're at 1.7, 1.8. I mean, we should be seeing a 30% sell-off in stocks. This isn't expected. It should be expected, right? Rates are going high. We should be expecting this. The Fed told us this months ago. But yet, you're just seeing this massive sell-off, regardless of any sector of stock, regardless of news or earnings. And again, I get it for the AMCs, Virgin Galactic's, GameStop's, marijuana stocks, EV names, with billion-dollar valuations yet to manufacture a single vehicle right now. I get it. I get the sell-off in those. But quality names? Even banks are selling off in an environment that should be very, very good for them. Higher interest rates, increase their margins. Gold stocks should be on fire right now, and some of them were, but they sold off tremendously. Uranium? Holy cow, uranium stocks got cut in half out of nowhere. Uranium, the profile is more bullish than it's ever been in terms of supply and demand economics, but a 50%, should that sector get destroyed? No, I don't think so. Even gold stocks, Bitcoin, and banks, these should be solid hedges in an inflationary environment, and even these names are getting destroyed because you're seeing leverage come out of the market and everybody sell. That's what happens. It's just kind of weird considering we don't have this massive, massive problem. Yes, we could go into recession. Yes, we should be down maybe 10% off our highs, but 20%? Stocks down 30% from their highs? Now, I know this is dreary. It's a terrible and ugly market. A lot of you have stocks in your portfolio down 30% plus, and I bet, even based on your emails, a lot of you are close to saying, you know what, F it, I'm going into cash. I'm done. I can't take it anymore. Before you do this, I'm going to say something. When it comes to small cap stocks, this may be one of the greatest buying opportunities I've seen over the past 10 years. I know that sounds insane. You're watching stocks get crushed, but buying on extreme sell-offs always sounds crazy, even though everyone says you're supposed to do that. That's what the best investors do. Best investors buy stocks when they're cheap. They buy distressed assets that they know they could turn around. So look at this sell-off as an opportunity because every name is getting nailed, and you know as well as I do, not every name deserves to get nailed. Some of them got good balance sheets. Some of them got good management teams. Some of them have great growth profiles in the right secular growth markets. They're seeing earnings strong. They raise guidance. They're getting nailed because leverage is coming out and people are selling no matter what. That's an opportunity. But keep sticking with me here before you think I'm crazy. So you look at the small caps, which have been annihilated since November, down over 20% from their highs. Okay, that's the entire index, not just, a couple of stocks. And the mean's probably 30% on average. The stock is down. But you're looking at the Russell down 11% just this year with 3 weeks in. Think about that, 11%. So to put this in perspective, the Russell is trading now at a 30% discount to large caps. That's a bigger discount than the credit crisis, COVID, and the largest discount since a 2000 tech crash. Again, which is absolutely insane. I'm not saying all small caps are a buy, but there's lots of names, literally dozens of them, solid balance sheets, great management teams, and growing earnings in the middle of those secular trends, AI, 5G, data analytics, digital sales, digital marketing, crypto, metaverse, autos. I'm not just talking about EVs, but those that supply and chip suppliers. I mean, those companies got nailed as well. Some of them down 25, 30%. I mean, auto companies have a lot of cash, especially if you're looking at Ford and GM. I mean, every one of these guys is going all in, spending tens of billions of dollars. Ford literally said we're going to spend $30 billion on new technologies, but just building these cars, that's going to result in a massive profit stream coming in for many, many years as everyone goes EV. I mean, that's not going to change. Should these stocks be down as much? And some of them, again, who just have crazy valuations, yes. But the chip companies, these guys got good fundamentals. Some of them, even in small cap land, pay dividend. And they raised their dividend last quarter, and they're showing massive free cash flow. Should these be down 25, 30% in this market? Is this a COVID credit crisis type of sell-off? No, it's a change that we all see coming. We all knew coming, and maybe we think it's going to be a little worse than expected. But this sell-off is crazy, especially for many of these small cap names. And one day I'm recommending CVO tomorrow, the biotech that has 10x to 20x plus potential. So you listen to my podcast, you listen to me for decades maybe. I don't throw around numbers like that. But this is a stock that has fallen 35% along with the rest of the market, especially biotechs got annihilated. And they're about to release phase 2 data, which I'm expecting to be positive, not because I have inside information. It's because its primary endpoint is going to be super easy to achieve based on their last study, which is extremely positive. Now, don't throw around the 10x, 20x potential gains, but this technology, this company is competing with the number one selling drug in the world. If they get it right, sales are going to explode over the next few years. If they don't get it right, yes, you're going to lose money on the name. But now that it's down 35% from its highs and you still have that upside potential, the risk-reward profile is much, much greater. And these are the names I'm talking about. If they don't get it right, yes, the stock will fall, but with the stock down, it lowers your risk profile while maintaining that incredible upside. And if you look at all the great investors, that's the goal. Maximize your upside while taking as little risk as possible or lowering that risk. And this is the opportunity. So I know you're seeing a lot of stocks in your portfolio that are down tremendously. And you're like, holy shit, should I just sell everything? But for me, most of the risks seem priced in here. I mean, small caps, so many great opportunities. And I understand we're going to see slower growth. I understand the Fed is tightening while economy earnings will slow. I get it. But here's what, and I don't want to say like a lot of people don't get, because I think some people get it, but here's a few things that you need to be aware of. So being down 20% in the Russell about 2 months, similar to the NASDAQ, which is getting crushed off its highs, at these levels where we're trading right now, it's not just pricing in your normal typical recession, which, again, we're not used to seeing because the Fed doesn't allow it anymore. They bail us out of everything. But where we are, this is pricing a very severe recession. And that's what any downside or further downside implies from here. And it's simply not the case. Now, you look at Omicron, it's about to disappear. And we're talking about a month or two from now, this isn't going to be a story anymore. We've seen it. We have the profile. We have, you look at the UK. You look at South Africa. I mean, look at these numbers skyrocket immediately and disappear completely. I mean, there's a lot of positives here. Where I think mask mandates are going to go away in 3 to 6 months. It opens the door to traveling, less fear. I just went to the Bahamas. Guys, if you're traveling internationally, holy shit. You really have to be tech savvy. I mean, yes, you have to get tested before you go, a couple days before, tested before you go back. Omicron's very easy to get. Sometimes you don't even know you have it. And if you have it, you're going to be at another country for at least 10 days. maybe 7 days now, whatever it is. And that's a real pain in the ass. But having to download this and take 40 minutes to go to fill out a Bahamas visa and then go to a specific app, depending on who you're flying, where you have to verify all this information and put it on there. And then you have the test results that they email you. And on the app on your phone, they're like, well, you have to take a picture of that, the barcode. And you can't take a picture of it. So you really have to go on a computer because you can't bring it up. Then you have to save it to your phone, which a lot of people don't know how to do. It's not that easy to save something to your phone, a file to your phone. It is for some people, but think about older people. And these are the people that travel the most. But you look at the Bahamas, when I went there, they said they have a 50% unemployment rate, 50%. And the hotel that I stayed at, which is beautiful, was completely empty. I mean, 80% of it, 85% empty. I have no idea how they're not bankrupt. But what I do know is in America, things are getting better. We like to travel, and things are going to open up a lot more over the next 3 to 6 months. And that's going to open the door for a lot of these countries who generate a lot of money from tourism. But that's easing. That's going to ease going forward. That's a positive. Inflation is also going to ease up. No, it's not transitory when it comes to energy, but it will be transitory when it comes to wages. And wages is what's really scaring the hell out of the Fed. I mean, they'd like to see decline wages, seeing wages go higher, right? It's a clear sign of inflation. Maybe not in energy as well, given the current landscape where, a bunch of nut jobs out there believe that, we have to go alternative energy, even though we don't have alternative energy to fill up that supply. So oil prices are starting to surge, and chances are they're going to go well over $100 until we start drilling again and become energy independent, since we have basically an unlimited amount of oil based on the price. And it sounds crazy, but if we're at 200, they'll drill 25,000 feet instead of 12,000 feet to frack. I've been to these areas. We have a ton of energy, so much so that when natural gas, which is a byproduct of oil, they're burning it for free, which they're not going to do anymore because natural gas prices are higher. They could sell it. But the fact we're restricting that, and I understand the whole climate change shit, I don't want to get political here, but it would be nice to have renewables to replace this before we start cutting back on oil. Because now every single problem, whether it's the UK, the Ukraine, Russia, China, something that could disrupt oil supplies is going to be amplified now. And the fact we're sitting on this much oil and not being able to drill it is crazy. That's going to result in higher prices. But if you look at everything else in terms of inflation, home prices are starting to fall. You're going to see food prices start to fall because people are going to change their habits. They're not going to pay. They used to pay $60, $70 going to maybe, their local restaurant for burgers and fries with a family of four. Now they're paying, $80, $90. Eventually they're going to say, hey, you know what? That's not worth it to me. I do see food prices coming down. You're going to see the supply chain bottlenecks, which has caused inflation, ease. Because Omicron's going to die down. I mean, a lot more workers working on to get things out a lot quicker at the ports. But also you're going to see slightly slower demand. Now, with the Fed taking leverage out of the market. But supply chain, something I follow religiously, is getting better week after week, especially in the auto sector. You're seeing it get better. That's a positive.